Welcome, dear traders. In recent weeks, stocks have been steadily declining, while the US dollar has been rising to new highs. The greenback remains strong amid three fundamental factors: expectations of a rate hike, the geopolitical tensions in Europe, and the lockdowns in China. Interestingly, the same factors are dragging stocks down. Risk assets have incurred the biggest losses. They have been growing for 2 years, primarily thanks to stimulus programs and the low key rates. What happened during the Asian session? Let's find out. Inflation in the United States keeps climbing at the fastest pace, although the consumer price index slowed down slightly compared to the last year, and for the first time since August, inflation holds at its highs. Analysts could hardly imagine a year ago that inflation would have ever reached such high levels. For this reason, investors have more reasons now to anticipate a more aggressive monetary policy tightening. Not long ago, the majority of market players were certain about a 50 basis point rate increase in June and July, and now many speculators do not rule out the possibility of a 75 basis point rate hike in June. The CPI index amounted to 8.3% in April on an annual basis, down from 8.5% in March. However, it was a rather modest decline. The Fed anticipated a bigger drop after the first rate hike. Inflation is still hovering at a 4-decade high. Apparently, it takes more time before the Fed is able to take inflation under control. Analysts believe that the regulator will realize soon that the chances of a soft landing are getting slim, so it will have to face a harsh reality. Investors are also worried about a hard landing. This was why stocks dropped yesterday, and traders continue to get rid of high-risk shares. The sell-off was also unfolding in the Asian session. Following a decrease on Wall Street, Asian stock indexes dipped to a nearly 2-year low on Thursday. The US dollar, on the contrary, jumped to a multi-year high. At the time of preparing material for this video, the US dollar index has already hit 104.44 versus its main rivals. US Treasuries, which have been growing for some time, also remained in the green territory in the Asian session. They were gradually losing luster with the investors as an increase in the cash rate may hinder the long-term rally. Meanwhile, the US dollar lifted higher, approaching the range of 103.88 and 104.43. The Bank of Japan keeps monetary policy ultra-loose, going against the general trend of rate hikes. It also sets different goals. In its April meeting minutes, the regulator outlined that its main priority is to boost inflation rather than curb it. Moreover, given the current geopolitical situation, it would be unwise to change monetary policy parameters. As a result, the meeting minutes did not contain anything new. Last month, the watchdog left the interest rate unchanged at an extremely low level. Bank of Japan Governor Haruhiko Kuroda also said that the bank would not hike rates in the near future. He stressed that the recent spike in prices was a temporary factor. Besides, a weak yen is beneficial for the country's economy. Macro stats clearly reflect the results of an ultra-soft approach. In April, Japan's account surplus significantly exceeded the March reading of 0.52 trillion yen and the forecast figure of 0.63 billion yen. It surged to 1.56 trillion yen in April. This was quite bullish for the yen. An upward movement is visible on the chart. The yen flexed muscles against the US dollar, and at the time of preparing material for this video, the dollar-yen pair was trading at the level of 128.53. In the Asian session, it may fall even lower, moving within the range of 128.38 and 130.05. The Aussie, on the contrary, is unable to assert strength against the US currency. It's quite curious given that There are plenty of bulls factors for the Australian dollar. Australia had a positive trade balance of 9.3 billion, which indicated an expansion in export volumes. The national economy remains resilient. The government debt is at an appropriate level. Unemployment is at the lowest level and the labor market is strong too. What prevents the Australian currency from starting a rally? The Australian dollar is sensitive to monetary policy changes. It dropped to almost two-year lows amid the widening rate gap with the Fed. The AUD USD pair is likely to remain weaker for the same reason. The Fed is now more hawkish than other central banks, which exerts pressure on currencies traded against the greenback. Any hawkish comment from the US regulator may push the Aussie down. The weakness of the Australian currency versus the greenback is clearly seen on the chart. The pair is steadily moving within the downward channel of 0.6868 and 0.6953. At the time of preparing material for this video, it reached 0.6876. And that's all for now. Thanks for watching, and please do not hesitate to leave your feedback down below. Our analysts will be happy to answer your questions. And do not miss our next video review. See you soon!